Welcome to Deep Dive. Today, we're looking at something many dream about. Owning property in a place like, say, beautiful Phuket. Living that expat life. Maybe you've got a villa, maybe you're earning rent, or you have investments back home. Sounds amazing, doesn't it? But here's where it can get a little complicated. Living the dream, especially with income or assets in different places, taxes get involved. And that phrase pops up. Double taxation Thailand property. You start wondering, am I really going to pay tax twice on the same money? It's a worry.
It absolutely is, and that's precisely why we're doing this deep dive today. Our mission really is to cut through that confusion. We want to give you clear, practical insights on managing property taxes, whether it's rental income from here in Thailand or from back home, and crucially, how to make sure you're, not paying tax twice.
Right. So where are we drawing our insights from today?
We're using a really informative guide. It's called Phuket Property, Expats Guide to Double Taxation. It's published by Ocean Worldwide, their luxury real estate agency, actually based right there in Phuket since 2004.
Ocean Worldwide.
Mm-hmm.
Okay, I think I've heard of them. Luxury focus.
Exactly. Phuket and Koh Samui mainly. Their director, Sandra O'Neill, has apparently helped literally thousands of families and investors navigate this stuff over the years. So yeah, they really understand the expat situation.
That sounds like a solid source. Okay, so everyone listening, get ready for some hopefully aha moments and advice you can actually use. Could save you some stress and maybe some cash too. So let's start with the basics. For someone listening, maybe they own property here or earn rent abroad and bring it in. What's the key mechanism here? You mentioned something about agreements.
Yes, double taxation agreements, or DTAs. Think of them as international tax treaties, basically diplomatic handshakes between countries to stop their citizens from getting, financially hammered.
Okay, DTAs, tax treaties.
That's right. Their core purpose really is to prevent you from being taxed twice on the same income. It's about fairness. And Thailand has a pretty wide network of these over 60 agreements with countries all over the globe.
Over 60. Wow.
Yeah, it's quite extensive. And these DTAs are crucial because they spell out which country gets taxing rights on specific income. So say you live in Thailand, but rent out your flat in, the UK. The UK-Thailand DTA clarifies who gets the first bite at taxing that rent.
Ah, okay. It directs the tax traffic, so to speak.
Precisely. It helps you figure out who has the primary claim and, importantly, how tax already paid in the UK might be treated when you report that income here in Thailand.
Now, here's where I imagine it gets interesting. These DTAs, they're not all identical, are they?
Not at all. That's a critical point. Each DTA is unique. You absolutely cannot assume the rule for, say, France is the same as the rule for Australia. The specifics really matter, especially for how different income types are treated. Rental income might be handled differently than capital gains from selling a property. You've got to look at the specific treaty for your situation.
Right. And you mentioned getting credit for tax paid abroad. How does that actually work? Is it automatic?
Not quite automatic. That's a common pitfall, actually, assuming it just happens. If you paid tax on, let's say, rental income in France, the Franco-Thai Treaty usually allows you to claim a foreign tax credit here in Thailand. This credit reduces your Thai tax liability, acknowledging the tax you've already paid. But, and this is key, you need proof, solid proof.
Like what kind of proof?
Usually an official tax certificate or receipt from the foreign tax authority, something undeniable. Without that proper documentation, your claim for credit here could easily be rejected.
And then you do end up paying twice.
Exactly. So this mechanism, claiming the credit, is vital. It prevents you being penalized just for having international income streams.
So for you listening, understanding and using your specific DTA isn't just about ticking boxes for compliance. It could genuinely reduce your overall tax bill here in Thailand. It's about protecting your bottom line. Okay, let's get practical. Let's unpack how rental income and property sales, probably the two most common scenarios, are handled tax-wise, starting with rent.
Right. Rental income. If you receive rent, maybe from that lovely Phuket villa or a condo near Surin Beach, and you bring that money into Thailand, it's considered taxable income here. The good news, though, in Thailand offers a pretty generous 30% standard deduction for general property expenses.
30% standard deduction? How does that work?
It's quite straightforward. If you bring in, say, 1 million baht in rent, you could automatically deduct 300,000 baht for expenses. So you're only actually taxed on the remaining 700,000 baht. It simplifies things massively. You don't necessarily need to track every single little receipt for repairs or agent fees unless your actual costs are way higher than 30%. For many, it saves a ton of bookkeeping hassle.
That sounds convenient. What about filing? When do you report this?
There are typically two key filings. There's a mid-year return, the PND 94, which covers income from the first half of the year and is usually due by September 30th. Then there's the main annual return, the PND 90, due by March 31st of the following year. This covers all your income for the entire previous calendar year. And of course, you absolutely need a tax identification number, a PIN, to do any of this filing. Getting that TIN is usually step one.
That 30% deduction does sound appealing for simplicity. But what if someone...
Yes, it's a strategic choice you make each year. Before filing, you basically calculate it both ways. Tax owed using the 30% standard deduction versus tax owed using your actual itemized expenses. Then you pick the method that gives you the lower tax bill for that year.
Got it. Flexibility, but requires doing your homework. Okay, now what about the other big one? Selling a property. Let's say you sell that amazing 9-bedroom place in Bangtao, Phuket, or maybe you sell a property back home. Taxes must be a big consideration there.
Absolutely. Selling property brings up significant tax points. Let's break it down. First, if you sell property inside Thailand, any profit you make, the capital gain, is subject to Thai income tax. Simple as that. It doesn't matter where you park the money afterwards. If you bought for 5 million baht and sold for 7 million, that 2 million baht profit is taxable here.
Okay, domestic sales are taxed on profit. What about selling a property outside Thailand? Say you sell your old house in Canada.
This is where things get interesting, especially with recent changes. Historically, Thailand used a remittance-based system for foreign income, including capital gains from foreign property sales. Under the old rules, that profit from your Canadian house sale was only taxable in Thailand if you brought the money into Thailand within the same calendar year you earned it, or generally within 1 year.
So timing was everything.
Exactly. If you held that money overseas for more than a year, or if the sale happened before you became a Thai tax resident, remitting it later usually didn't trigger Thai tax. But, as we'll discuss, this has changed significantly.
Before we get to the changes, how do you calculate the taxable gain on a sale here in Thailand? You mentioned profit, but how is that defined?
Good point. There are two main ways to calculate the taxable gain, and you need to choose one carefully. Method one is the actual profit basis. This is pretty logical. Sale price minus original purchase price minus direct costs.
Direct costs like?
Things like transfer fees, legal fees, agent commissions, maybe documented costs of major improvements you made. You need records for all this. Method two is the standard deduction based on holding period. Instead of tracking actual costs, you deduct a fixed percentage from the sale price based on how many years you own the property.
How does that work? A percentage off the sale price?
Yeah. The longer you hold, the bigger the percentage deduction. For example, holding for just 1 year might allow a 92% deduction, meaning only 8% of the sale price is treated as taxable income. If you held for, say, 8 years or more, the maximum deduction applies, which is 50%. So only half the sale price is considered income. The percentage is scaled down the longer you hold.
Wow, 92% deduction after just 1 year seems high. Or 50% for long holds. That sounds potentially much better than calculating actual profits sometimes.
It absolutely can be, especially if the property value increased significantly and your original purchase price was relatively low, or if you simply don't have perfect records of all your expenses over many years. The standard deduction method offers simplicity and often a lower taxable amount for long-term holdings.
So again, a choice. Actual profit versus standard deduction.
Yes, and it's a critical choice.
Yeah.
Because, and this is a really important heads up for everyone listening, once you choose a calculation method for a specific sale when you file your taxes, you cannot change it later.
You're locked in.
Locked in for that particular transaction. So you really need to run the numbers both ways before you file. See which method results in less tax. Do your homework.
Definitely sounds like strategic planning is key here to, manage your tax effectively and not pay more than you need to. Okay, you hinted at some big changes related to bringing money in from abroad. This sounds crucial, especially regarding Thai tax residency. Let's dive into that.
Yes, this is where things have shifted significantly, and it's something every expat needs to be aware of. First, let's quickly define Thai tax residency again. Pretty simple. Spend 180 days or more in Thailand within a calendar year. That's it. Doesn't matter what visa you're on or your nationality. Purely physical presence.
180 days. Got it.
Now, as we said, Thailand historically used that remittance-based system. Foreign income wasn't taxed unless brought in relatively quickly after being earned. But the game changed on January 1st, 2024. There were major updates to the remittance rules.
Okay, what's the new rule?
The new rule is this. Any accessible overseas income brought into Thailand by a Thai tax resident is now subject to Thai personal income tax, regardless of when that income was originally earned.
Regardless of when it was earned. So that 1 year grace period or the idea that old income was safe, that's gone.
Essentially, yes. That's the massive shift. The previous rule, where income remitted more than a year after earning it was generally exempt, no longer applies to accessible income brought in from 2024 onwards.
Wow. That is a huge deal. So if you have savings offshore, maybe from income earned years ago, before this rule change, bringing it in now could trigger tax.
Exactly. If you were a Thai tax resident when you earned that income, even if years ago, or even if earned before becoming resident, but brought in now while you are resident, remitting those funds after January 4, 2024 could make them taxable here.
That really changes the strategy for managing offshore funds. Can you give us an example? Say I sold a property overseas 5 years ago, kept the cash in a foreign bank. Now I'm a Thai tax resident and want to bring it over for, I don't know, a deposit on a Phuket condo. How does that look now versus before Jan 1st?
Great, very practical example. Before January 1st, 2024, you bring that 5-year-old property sale money into Thailand. Since it was earned well over a year ago, under the old rules, it likely wouldn't have been subject to Thai tax upon remittance. The time gap was your shield.
Okay, that was the old way.
Right. Now, under the new rules, you're a Thai tax resident. You bring those same 5-year-old proceeds into Thailand after January 1st, 2024. Those funds are now potentially accessible for Thai income tax in the year you remit them. The when-earned distinction for remittance timing is basically gone for accessible income. It's now about when you bring it in while being a resident.
So the timing of remittance is now the absolute key factor for triggering tax, not necessarily the timing of when the income was earned offshore.
Precisely. So strategic timing is still critical, but the strategy is flipped. Income earned and remitted in the same year was always taxable and still is. Income earned before you ever became a Thai tax resident and kept offshore, that specific pot of money is generally still considered non-taxable if remitted later. It's seen as capital required before residency.
Ah, okay. So pre-residency earnings might still be safe.
Generally, yes, but proving the source and timing is crucial. But income earned while you were a non-resident, but maybe still visiting Thailand occasionally, or income earned while technically resident abroad, but then remitted here after Jan 1, 2024. That's the income now potentially caught by the new rule.
This is complex. And how much tax are we talking? Does it get added to my other Thai income?
Yes, it gets added to your total assessable income for the year and is taxed according to Thailand's progressive personal income tax rates. Those rates start at 0% for the first 150,000 baht of net taxable income, then step up through brackets 5%, 10%, 15%, and so on, up to a maximum rate of 35% for income over 5,000 won baht.
So bringing in a large lump sum from overseas could push you into a much higher tax bracket.
Absolutely. It makes careful planning for large remittances even more essential. You need to factor that potential tax hit into your decisions. One potential relief valve here, though, is worth mentioning. Specific visas like the long-term resident or LTR visa.
The LTR visa, how does that help?
Well, for eligible folks, think highly skilled professionals, wealthy individuals, certain retirees, digital nomads. The LTR visa can offer significant tax benefits, including potentially a flat, reduced personal income tax rate of 17% on certain qualifying income for up to 10 years. It's definitely something to investigate if you might qualify, as it could fundamentally change your tax picture in Thailand.
Okay, so the LTR visa is a potential avenue for some. But for most expats, understanding these new remittance rules is absolutely vital for planning any fund transfers from overseas. Getting this wrong could lead to some very unpleasant, unexpected tax bills.
Right, so given all this complexity, the DTAs, the income rules, these big remittance changes, what are the practical steps people should be taking right now to manage their taxes properly and avoid those nasty surprises?
Good question. Let's boil it down to actionable steps. First, basics. Get a tax identification number, a TIN. It's essential. You generally get this by visiting a local revenue department office. You'll need your passport, maybe your work permit if you have one, perhaps an alien registration card, and definitely proof of your address in Thailand. Okay, TIN first. Then what? Documentation.
Absolutely. Gather everything needed for your tax returns. That means your TIN, passport visa info, and critically detailed records of all your income, both Thai-sourced and any foreign income you've remitted under the new rules. And the special note for U.S. expats listening, remember your obligations back home. Things like FBAR for foreign bank accounts and FTC reporting. The penalties for non-compliance there can be severe, sometimes even more so than Thai penalties.
Speaking of penalties, what happens if you mess up here in Thailand? Late filing or underpayment?
There are definitely consequences. Late filing usually incurs a penalty, maybe around 2,000 baht. More significantly, there's a monthly surcharge, like interest, of 1.5% on any unpaid tax amount. That 1.5% per month adds up very quickly, so timely filing and payment are key.
Okay. Any specifics for condo owners? You mentioned management fees earlier.
Yes, for rental condos, besides the general 30% standard deduction option, if you itemize, you can typically deduct those recurring common area management fees, security, pool cleaning, admin fees, contributions to the sinking fund. These are direct costs of maintaining the rental property. Also, ensure your lease agreements comply fully with Thai law and the Condominium Act. Using standard, legally sound contracts is important, especially if dealing with foreign tenants or management companies.
And the overarching theme seems to be
Record keeping. I can't stress this enough. Keep meticulous records of all property-related income and all expenses. Every receipt, every invoice, every contract. Think of it as building your defense against any future questions. It's absolutely vital.
so be organized.
Be very organized. And finally, given the complexity, especially with the new remittance rules and interacting DTAs, don't hesitate to get professional tax advice. Seriously. Especially if your situation involves multiple countries, different income types, or large sums. A good tax advisor who understands expat issues in Thailand is worth their weight in gold. They can help you navigate the rules, claim eligible deductions and credits, and ensure you stay compliant.
Right. Being meticulous, keeping good records, and getting expert help when needed, it really sounds like the way to empower yourself, make the most of the system legally, and avoid trouble down the line. Lets you enjoy that Phuket sun without a tax cloud hanging over you. Well, we have certainly covered a huge amount of ground today. From understanding those crucial double taxation agreements to the specifics of rental income and capital gains, and especially digging into those really significant new remittance rules, plus the practical steps to stay on top of it all.
Yeah, I think what's fascinating here, or maybe just really important, is seeing how knowing these details can make a real difference. Like that 30% standard deduction, simple but powerful. Or the choice between calculating capital gains methods. And especially understanding the timing implications of the new remittance rules, that's critical now. It just reinforces that TTAs aren't just legal jargon. Used correctly, they genuinely shield your finances and stop you paying tax unnecessarily. Staying informed is really your best strategy.
It really is. Which leads me to a final thought for you, our listener, to maybe mull over. In this world where money and assets flow so easily across borders, where does your personal responsibility lie? Not just legally, in terms of compliance, but maybe ethically too. How important is it for you to truly understand the global journey of your own income and assets, and to stay proactive in navigating a tax landscape that's clearly always evolving? Something to think about. Thank you for joining us on this deep dive. Until next time, stay curious and stay informed.